You can duck a counterparty you don't trust. You can transfer it to a different counterparty, or you can take personal custody. And that's why it's a useful asset right now. And it ought to be part of people's portfolios. And I can't think of anything better.
Michael, I want to be sold on Bitcoin. Give us your best pitch as to why someone with no Bitcoin should buy some Bitcoin today.
I think we're living in a very uncertain world right now, and there's a lot of political uncertainty with regard to politics, trade policy, labor policy, manufacturing policy. So if you're considering investing in a company, the question you have to struggle with is, will the company be impacted by tariffs or trade policy or tax policy or labor policy or manufacturing policy or a war or a famine? And so that's the first uncertainty. The second uncertainty we have today is monetary uncertainty. We see a lot of countries with their currencies collapsing. In Argentina, they just implemented some capital controls limiting the amount of US dollars that companies are allowed to hold. In Zimbabwe, they're dollarizing. Their currency has literally collapsed to nothing. And so if you're holding a currency, or you're holding a company or a bond that generates cash flows in anything other than the dollar, you have a massive amount of uncertainty and risk. If we look at the last 12 months, the euro has weakened against the dollar, the pound has weakened against the dollar, the yen has weakened against the dollar, the Turkish lira has weakened against the dollar. In fact, just about every currency in the world is collapsing against the dollar, anywhere from 10 to 20 to 30%. And in Turkey, it's about 90% in 12 months. So there's a lot of monetary uncertainty to go along with that political and that commercial uncertainty. We call the two things together stagflation. You've got a stagnating economy, you've got an inflating money supply, which means that your currencies are buying less. So if you're any individual and you're looking out over the course of a decade, and you have any capital that you wish to preserve, or you're generating cash flow from your job, the question is, what do you do to insulate yourself from stagflation? And if you rifle through the list of options, you can invest in companies, but which company? If you invest there's no company in Zimbabwe that'll save you. So I guess if you X out all the international companies and you invest in domestic companies in the country where you live, the question then is, do you actually know enough to handicap their performance? 98% of the companies are actually not monopolies, which means that they're getting eaten by Google, Apple, Amazon, Facebook. So if you're buying a non-monopoly company, it's risky for all sorts of reasons. If the company has employees, it's risky because of employment taxes and labor policy and unionization. If the company manufactures things and moves them cross borders, it's risky because you end up with tariff barriers. It may be, if you manufactured great stuff in China, you can't bring it to the US. Maybe it gets banned. So if you're trying to save your capital by investing in companies, you take on all sorts of corporate risk. If you're trying to preserve your capital by buying bonds are currency derivatives. They're valued based on cash flows. So if the dollar supply increases by 15% a year, you have to discount the bond cash flows by 15% a year. That means that every 5 years or so, they're worth half as much. If you're holding the cash itself, that's obviously a currency derivative. It's collapsing in value. I think last I checked, real estate in Florida has escalated in price 500x over 90 years. 500x. In 100 years, it'll escalate 1,000x, which means that your currency will lose 99.9% of its value against property, scarce desirable property, over 100 years. That's assuming about a 7% monetary inflation rate. It looks like the US is running 15 to 20% monetary inflation rate. You can keep track of the strength of every other currency. So if the Great British Pound lost 13% against the dollar, then you're up to 33% inflation rate. And of course, with Turkish lira, you're much higher inflation rate. So a person's got to figure out how they're going to store their life savings. And if I'm not going to hold it in a currency, and even if I hold it in a currency, not only do I have the inflation risk, I have the counterparty risk. The banks will actually freeze your funds if you live outside the US. Banks are freezing people's funds everywhere in the world right now. In the US, perhaps your funds won't be frozen. You'll just have the currency collapse. So there's a risk with currencies. There's the obvious risk with bonds. There's a risk with stocks. And that takes you to property and collectibles. So maybe you collect Rolexes. A lot of people are doing that. A lot of people, you can see what people are doing in this macroeconomic environment. They're buying watches. They're buying luxury cars. They're buying real estate. If you look over the past 2 years, the money supply expanded by 40%. Single family homes in the US increased in price by 40%. So it looks in the near term, over 2 years, like single family homes are a pretty good inflation hedge. Bitcoin's performed better than single family homes in that time frame. But now we're stuck with this issue of, well, are single family homes an inflation hedge over a decade? And the challenge there is that as the price of homes go up, then there's an incentive for home builders to build more homes. So commodities, they have an appeal, but if you can produce more of a commodity, then if I increase the price by a factor of 10, I increase the incentive to build that thing by a factor of 10. So silver, gold, lumber, oil, homes, real estate in general, they're all subject to supply-demand elasticity. And when the demand increases, the supply is going to increase. That's why a lot of people they actually prefer branded items controlled by monopolies. I think they probably almost believe that Ferrari and Rolex are more reliable. They'll keep the supply capped. Like, it's not likely that a random suburban ranch house in middle America will have a capped supply, because there's no single monopoly or brand organized or brand controller to keep that supply from getting out of control. So the general strategy when you're staring at inflation is, I want to acquire scarce desirable property that I can hold for a long period of time. If I'm going to hold it for a long period of time, that means I got to be able to afford to maintain it. If you buy a really nice beach house in Palm Beach, you find that you have a 2% of your property tax. So in a decade, you have to come up with 20% of the purchase price to maintain it. Then you probably got to come up with another 1 or 2% per year to pay for wear and tear, hurricane insurance, electricity, repainting, whatever there might be. So if you take 4% a year of the purchase price, that means that you have to come up with 40% of the purchase price over a decade to maintain it. Bitcoin's not going to cost you 40% of its purchase price to hold it for a decade. So the maintenance cost on digital property is lower than the maintenance cost on physical property. The scarcity on a digital commodity, well, that's a function of the protocol and the integrity of the protocol. So if I create a product like Dogecoin and I know I'm going to print more Dogecoin every year, right? It's not quite 5% inflation a year, but it's an inflating supply. Well, then you don't have a hard cap. You've got an increasing supply. It'll continue to increase in supply forever. That's an uncertainty. If a small group of people can change the protocol, that's another uncertainty. The reason that we don't trust stocks as money over 100 years is because the board of directors and the CEO can change the supply of the stock. So Apple might be a good company, but if the CEO of Apple changes, the new CEO might double the supply of the stock. And so it doesn't necessarily make a good currency or a good money over the long term. So I think in short, commodities are increasing in price right now. Oil, wheat, soybeans, natural gas, all of those have surged in the past 12 months.